Let's study EA Capital's market temperature card to get a sense of where we stand in the economic cycle and what should investors expect going forward. In this video, we will first analyze the data in market temperature card, as on October 5, 2023, and then summarize our view in later part of this video. If we study different segments of the markets, in terms of large cap, mid cap and small cap, the Nifty 50, which is the large cap segment, with an earnings yield of 4.54%, which means a PE ratio of 22, seems to be relatively cheaper, compared to mid and small cap. In valuation terms, Nifty 50 is followed by Nifty Small Cap 250 Index with earnings yield of 4.09%. The Nifty Mid Cap 150 Index seems to be most richly valued at current juncture with PE of 26.5. If we further look at bond yields, the India 10-year bond is currently offering an annual yield of 7.21%. The yields have spiked, as bond prices came down in past few days, primarily, as a result of heavy US bond selling done by China, taking US bond prices lower and yields higher, which has a contagion effect on Indian bond yields as well. Elevated crude oil prices further has a negative impact on inflationary expectations, which takes bond prices lower and hence, bond yields higher. The American Dow Jones Index offers an earnings yield of 4.16%, which is not much lesser than the 4.73% offered by the 10-year US bond. The good news for India is that Brent crude prices have sharply fallen to $84.50 a barrel, which augurs well for the Indian economy. The volatility index, known as VIX or the fear index, has spiked to a value of 18.6, which signifies increased fear among market participants. Ticker Tape's Fear Greed Index depicts a value 34.9, which is in the fear zone and closer to extreme fear zone. If its value falls below 30, we take the Fear Greed Index as a contra-indicator and have seen time and again markets bouncing back in near term when Fear Greed Index depicts fear or extreme fear. The BEAR ratio, also known as Bond to Equity Earnings Ratio, is at 1.58, which is arrived at by dividing the earnings yield of India 10-year bond at 7.21% by Nifty earnings yield of 4.54%. Though BEAR ratio at 1.58 signifies above average valuations for Indian equities, but with very positive real GDP forecasts for Indian economy, improving corporate profitability in coming quarters, expectations of interest rates cooling off, inflation remaining under control as Brent crude prices cool off, it looks unlikely that broader Indian markets will see a deep correction from these levels. The macro indicators also suggest strong on-the-ground activity and growth. GST collections continuously remain very strong with latest number at over Rs 1.62 lakh crore for the month of September 2023. Along with GST collection number, both manufacturing and services PMI also signify strong expansion in manufacturing and services sectors. Investors should note that a value of over 50 on the PMI index signifies expansion. Along with this, India's forex reserves stay strong at over $590 billion. Our forex to external debt ratio stands at a very healthy 96.2%. To summarize, our reading of the data says that the Indian economy is displaying strong fundamentals, and our real GDP growth outlook is positive and India remains fastest growing major economy. The flows into Indian equities has been strong, led by domestic mutual funds. The foreign institutional investors were net sellers in last 30 days, but their weight to Indian equities seems to be in line to India's weight in the Morgan Stanley Capital International's Emerging Markets Index. Indian equity markets seems to be expensive to its emerging market peers on a 1-year forward earnings growth basis, but cheaper on a 5-year forward earnings growth basis. However, investors must also be aware of some risk factors which can dampen the positive sentiment for Indian equities. These may be, a. Uneven distribution of monsoon, hence rural economies' growth can remain under pressure. B. The US Fed has signaled possibility of higher interest rates for longer periods. This can potentially take US into recession and impact global growth. C. Higher crude oil prices for longer periods of time can negatively impact India's current account deficit and forex reserves and can pose pressure on Indian currency, thereby negatively impacting foreign flows. D. Markets seem to be pricing in political stability and continuation of reform process after the upcoming elections. Election results otherwise may possibly create upheaval. E. Geopolitical risks and escalation of tension between Russia-Ukraine. F. In equities, many unforeseen risk factors, which are not mentioned above, may have a significant negative impact in near term, though, in long term, earnings growth of investee companies tends to decide the returns earned by investors. What we would do with our portfolio: we feel it is wiser to focus on asset allocation in terms of equity and debt. We plan to stay invested in quality Indian equities, primarily through mutual funds, and along with it stay invested in high credit quality debt and high credit quality ultra short-term or liquid funds to have liquidity available to take advantage of the inevitable volatility in equity markets. We also plan to rebalance portfolios at opportune times, from pockets which we feel may be overvalued or if asset allocation between debt and equity deviates too far from our decided percentage allocation between debt and equity. Please note that the comments and views shared in this video are our personal views, as per our own understanding, and this should not be treated as any recommendation for buying or selling investments of any kind. Investors must do their own independent research, consult their investment advisors before making their investment decisions. We have done our best to ensure accuracy of data shown in the market temperature card, though, in rare case human error may be possible.